I would be reluctant to just be throwing away my gold or silver positions here in June based upon what the Fed is saying in the here and now, without taking a long, hard look at where this is all likely headed in the months to come.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for June 20th through June 27th, 2023, while supplies last. This week we featured 2023 1-ounce silver maple coins at $4.99 over spot and backdated 1-ounce silver Australian kangaroos at just $3.99 over spot. Silver maples were the first silver sovereign coins to be minted at 4/9 fine purity, and the 2023 silver maples remain one of the most in-demand coins today. They come 25 to a tube, 500 to a box, and are available at $4.99 over spot with a minimum order size of 1 tube. Next, backdated kangaroos are 4/9 fine 1-ounce silver sovereign coins of Australia, renowned for their purity and design. They come 25 to a tube, and with just 250 coins to a monster box, they are the most affordable monster box available, especially at just $3.99 over spot per ounce while supplies last. Our specials this week are IRA eligible, and if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Always nice to see you, Elijah. Thanks for having me on again.
Well, it's great to have you. I wanted to have you on as June comes to a close, and we're just about halfway through the year. I'd want to look back at your yearly forecast you wrote at the beginning of January. You mentioned how the first half of the year, the Fed was going to continue to raise rates. We were going to see a kind of a calm precious metal market, kind of boring. And I was actually looking at the price of silver, and it's been pretty boring, actually. There's been its ups and downs, but it's pretty much completely flat from the beginning of the year. We're seeing a bit of a beating today, making it fall a little below where we started. But your perspective where we are, and now, last week the Fed paused. So you mentioned in the yearly forecast that the Fed was going to kind of pivot mid-year. Your perspective on where we are in the metals and also what the Fed is doing right now.
Well, it's all an interesting story. And we all feel so down and out, especially as you see price going down several days in a row. But yeah, gold, as we speak, is up $100 year to date. It began the year at $18.29 and is about $19.29 or whatever it is as we record this. On track to kind of match its average annual gain since the year 2000. If you think of it as a new century, I think that gold has annualized about 9.5% in dollar terms every year. So we're on anyway. So you look at that and think, okay, well, it's doing what it's supposed to do. And yet, boy, we all kind of feel downtrodden, and I do as well. I'm not trying to say I don't. It is frustrating to watch. But again, the idea that this year was going to play out similar to other years in the past, where the Fed entered the year with rhetoric of higher rates and then ended the year moving toward lower rates, certainly seems to be playing out that way. The only frustration is in this delay, this waiting for everybody to get on board that the Fed is cutting. Now, at present, the notion is that there's not going to be any rate cuts now this year at all. That's what the market's been adjusting to for the last week. And that, all the rate cuts are going to come next year. That's a radical change from what I was expecting or what the Fed funds futures markets were pricing in as of a week ago. And we'll see. I'm not ready to say that run up the white flag and say this whole year is lost and that the Fed is going to keep rates where they are all the way through Christmas time. There's a lot of year to go and a lot of economic uncertainty that is still coming at us. But I guess the main thing that people should understand is the Fed themselves are predicting some rather dramatic economic events in the next 12 to 24 months. Elijah, the Fed meeting last week was obviously the one in June. And on those quarterly meetings, March, June, September, and December, the Fed puts out what they call their summary of economic projections. Now, you can say, well, whatever. These are just a bunch of academics, most of whom have never held a job outside of the Fed, and who cares what their projections are? But they all get together and they all make their little guesswork based off their own, regional bank statisticians and economists, what they're telling them. And there's two things that kind of got glossed over in all of this. On that official Fed policy statement, that summary of economic projections, they state that from the current 3.7% unemployment rate to the end of next year, they're projecting that to rise to 4.5%. Now you think, well, that's not much. That's not even 1%. But on a percentage basis, that's a change of 21%. This is not a small little detail. The Fed themselves projecting that the unemployment rate is going to go up by 21%. How many people is that putting out of work? Maybe even more important, all this hubbub about the Fed, now they're going to hike in July and maybe again in the fall. The Fed themselves projects 100 basis points of rate cuts in 2024 and 125 basis points of rate cuts in 25. So the hard part is getting kind of caught up in the minutiae and the red prices that you see, every day this week, and instead focus on the bigger picture. And that's, I think, where gold and silver investors need to remain.
Now, with respect to what the Fed is going to do, you mentioned how they're originally at the beginning of the year, you were looking for rate cuts this year. So is that still your view, or what could change the Fed's projections there?
Yeah, that has been my forecast all along, is that by summertime, it'd be pretty obvious that the economy is slowing and that the Fed would pause, pivot, and start cutting rates. And till last week, this was not an unusual position. The Fed funds futures were projecting the first cut as soon as September and another one in December. So my position wasn't really that radical. It's not like, I just kind of came up with it on my own, but it ends up being in line with what the market, if you will, was saying. Now, again, hey, look, I'm, who am I? I'm just this, guy with a computer out here in the middle of nowhere that has a platform to speak. I could be wrong. Fed funds futures traders, they could be wrong as well. And maybe maybe everything's fine. Maybe the economy just keeps rolling along and inflation, remains high and the Fed keeps on hiking and we end the year with a Fed funds rate of 6%. Maybe. And if that's the case, the back half of this year, probably going to be more like the first half of this year and not much fun for all of us. However, the Fed on this rate hike cycle has hiked rates faster than they ever have, ever. And so you can look at that and say, well, they don't really know exactly what the outcome is going to be. They can project and pretend and go off of whatever indicators they want and say everything's fine, but they don't know. Go back to March, Elijah. March 7, Powell's on Capitol Hill giving his semi-annual Humphrey Hawkins testimony. And on that meeting, he was talking about higher for longer. And maybe in the March meeting, they were going to hike 50 basis points and all that stuff. About 4 days later, here came the problems at Silicon Valley Bank. So that would suggest Powell had no idea that the Silicon Valley Bank issue was pending, that this caught the Fed by surprise. It certainly seems now in hindsight. Mary Daly at San Francisco Fed had no idea what was going on. And of course, we know Silicon Valley Bank was quickly followed by the third and the fourth largest bank failures in U.S. history, Silicon Valley being the second largest. So this idea that, on a day-to-day basis, the Fed thinks everything's just fine. Okay, but that can be turned upside down pretty quick. And so, I don't know, I would be reluctant to just be throwing away my gold or silver positions here in June based upon what the Fed is saying in the here and now, without taking a long, hard look at where this is all likely headed in the months to come.
No, as for gold and silver prices right now, we're looking at a silver below $23, gold around that 1920, 1930 area. It seems like, a lot of people didn't expect prices to get back to these levels. Some people did. But do you see it could go significantly lower from here?
Well, I suppose it could do anything, anything's possible. The commitment of trader structure is pretty well washed out. I mean, I think we've seen a lot of hedge funds and speculators dump their positions this week, which is because a lot of the selling has taken place during COMEX hours. So you kind of get washed out, and I think a lot of the hedge funds probably look at it and go, well, geez, if there's not going to be any rate cuts for 6 more months, why are we holding these gold futures contracts when we can take this money and put it somewhere else over the next 6 months? We can come back, later. And so, how far could gold continue to drop? Well, I don't know. The next support level is 1920. That's an old, significant, important level because that's the old all-time high from 2011. And gold has kind of oscillated around that level, finding support and resistance there, depending on which way it was approaching that number, quite frequently over the last 3 years. So 1920 would be a key level to watch. Below there is the 200-day moving average for COMEX gold, which is down around 1885, 1890. I don't know. I have a hard time seeing where price falls dramatically below there. And I have a hard time seeing silver fall dramatically below 22 and staying there, because we start getting into this area where it is at or below the cost of production of those metals. And price, we learned, in 2014 and 15, and again in 2018, the price can go down toward that cost of production. But usually when you get close to there, the banks that make the markets and the futures contracts start to go long instead of always hedging short. And so they provide kind of a little bit of a floor that's related to that physical price that kind of precludes it going lower. So I guess what I'm saying is there's a limit to the downside from here. I mean, I watch this stuff all day long, and I see people on Twitter that are trying to count their waves, and do all this other jazz, trying to say gold could go to 1,400 or 900 or something like that. And I just don't think that the physical market can allow that, because, I mean, there have to be physical trades that are facilitated at that level. And I think that those physical trades kind of provide a little bit of a floor to that paper price. And again, we've seen that in the past, and I would imagine that would be the case again now.
So we're seeing obviously a fall in the spot prices of gold and silver, but we're also seeing this phenomenon where the COMEX and LBMA are in some sense now acting as a physical delivery system, which they weren't really ever intended to be. Your perspective on that and the extremely low levels of physical silver we see on the COMEX, I believe it's around 27 million ounces last time I heard when I've had David Morgan on earlier this week, 27 million ounces in the registered category. So your perspective on that?
I didn't see your interview with David, but I would imagine he mentioned something about how his experience has taught him that anything below 30 million is kind of a buy signal. So we're 27, we're 10% below that. The Silver Institute has put out those studies of, last year a $247 million supply or million ounce supply deficit, that sort of thing. And all these things factor in. The paper price gets pushed down, it gets unprofitable to mine it. Now silver is kind of a different animal because a lot of silver is pulled out of the ground as a basis of other mining, copper and nickel and lead and the like. Silver just kind of comes out with it as a byproduct. But nonetheless, I mean, there is kind of this physical factor that eventually impacts how low a silver price can go. I mean, it's like, it could go to 10. Sure. I suppose it could. I could also probably, come up with some theoretical physics that would say that, you could pick up an elephant and throw it. But that's, again, your experience, your understanding, your wisdom knows that that's really not the case. And I just don't think there's physical silver to be delivered in London at $10 an ounce. And so there is this physical floor, where The fundamentals of physical supply and demand really don't drive the COMEX price on a daily basis, but they do, in the end, impact how low price can go. Because, without really getting deeply into the weeds about how this works, but it is the big banks, what we call bullion banks, that are responsible for delivering metal, flowing metal, primarily through London, at this discovered price of trading of the futures contracts and the forward contracts. It's those banks that are on the hook for taking that price and delivering metal at it. So as price falls and metal gets harder to come by, if it's below the cost of production, the banks begin to think, well, we better go long here. Rather than the short positions that we always maintain, maybe we ought to start going long because we got to make sure we have metal to deliver. This, as recently as last fall, Elijah, when silver was banging around down near $18 and $19 an ounce, there were 4 separate occasions where it was the hedge funds that were massively short 15 and 20,000 contracts, and the swap, what they call swap dealing bullion bank trading desks, were net long 15, 20,000 contracts. And so what would happen? On 4 separate occasions, there were these massive short squeezes of these speculator hedge funds, and price shot up from 18 to 20 or 18 to 21. So I would imagine, as this continues, we'll get a commitment of traders report coming up tomorrow night, the 23rd, that'll show on the last week how much specs have dumped and banks have covered shorts. As this continues, if price goes down again to 20 or lower, we're going to be right back in the same spot that we were last fall, where the banks are long and the specs are short. If experience has taught me anything, you want to be on the banks usually win. So all of that, precludes, I guess what I'm getting at, between the Fed policy of eventual rate cuts, unknown economic damage is being done. Okay, eventually they themselves are telling you that by next year they're going to be cutting. Okay, put all that together, knowing that there's probably far more upside potential than there is downside risk from here. That makes it a time that people shouldn't be panicking and dumping. The old adage at TFMR, when things look the worst, you've always got to buy some, probably applies here.
You mentioned how when the commercial banks are going long, that's probably the time to be long, and when they're going short, that's the time when you're probably going to see a price drop. Where are they right now? You mentioned it back in September, that time area, they were definitely long, but where do they stand right now?
I got it right here. I keep this whole stack on my desk. I write these down every week just so I have it handy. How's that? That's a little old-fashioned old man stuff. As of last Tuesday, the 13th, the swap dealing banks. What are swaps, right? Those are derivatives. What are derivatives? Options and futures contracts. Who deals them? The banks. So when you get into your CFTC weeds on the disaggregated report and you see a category of swap dealers, those are the bank trading desks. And as of last Tuesday, the 13th, they were net short COMEX silver about 11,500 contracts. And the what's called hedge funds in that category, they were net long about 13,000. Now, those numbers are down from their peaks as prices come down. But as you go back to last fall, November, October, even once in December, those positions were flipped. It was the banks that were net long 13,000 and the hedge funds that were net short. And if you go back and look, and I was writing about this a lot, and I'm sure discussed it last fall, there were 4 separate, very sharp short squeezes of 10 to 15% in a matter of a couple of days, where price went up and the banks got squeezed. It was no different from when the specs are really, really long and the banks are really, really short, and you get these smash waterfall declines where all the specs run for the exits and dump. These short squeezes are when you get these smash, spikes up where specs run for the exits and cover their shorts. So anyway, again, as of last Tuesday, this is now 9 days ago. This is before the FOMC last Wednesday and everything that's happened since. Again, the banks were net short 11,000 and the funds were net long 13,000. I'd invite everybody to go to cftc.gov after 3:30 Eastern on Friday, the 23rd. Go to the disaggregated report and do the math. And you'll see, I would imagine, given the trend this week of price and open interest, I would imagine the banks will, at least as of Tuesday, have probably cut that position in half. They'll still be net short, but maybe only about 5,000. And as price declines, they'll cover more shorts as the specs dump longs and add shorts. And those, we'll get to that position again if price does keep going down, where it won't go any further, and we'll be back, to where we were last fall.
Well, it will be very exciting to continue to track this with you, Craig. Any last thoughts before we let you go? I know it's definitely, as you mentioned, kind of a difficult time in the metals, but at the same time, I've kind of been looking forward to this because I think it's a good time to, for those who are looking to add to their position, to add it at this time. And obviously, we can't give financial advice, but that's just my opinion here, your perspective. Right.
I mean, it's deja vu all over again. Having run my site here for 13 years, I've been through this before. I mean, the Fed rhetoric in 2010 was all about the green shoots coming out of the great financial crisis and that the balance sheet was going to go back to whatever normal was and interest rates were going to go back to normal. And it never happened. And by late 2010, here came QE2 and precious metal prices took off. And 2015, they were playing the same game. And by early 2016, the economy turned south. The Fed had to cut back on all the rhetoric, and metal prices and share prices took off. 2018 into 2019, here we go again, normalizing the balance sheet, and all this stuff. And that didn't happen. And they started cutting in June, and metal prices and share prices took off. And here we are again. I mean, I have a long memory just because I've been doing this for so long. And it's my sole focus. But I think it's so easy for people just to kind of get caught up in the minutia of the rhetoric on a day-to-day basis and think somehow this time is different. It's not. The Fed will be cutting, and they will be restarting QE. I mean, we're running $2 trillion annual deficits. Okay, this is happening. The best thing people can do is, maybe add to your stack if you've got some extra cash laying around. But at least, if anything, maybe just do nothing. Walk away from your computer and just let this play out over the next 3 to 6 months. And then I think you'll be richly rewarded if you do.
And if people are interested in tracking this with you, they can go to tfmetalsreport.com, which is not only your own writing there and podcasts, but also a fantastic community, as you've mentioned before, if you want to tell us about that.
Nothing could be more important in 2023, right, than just not being isolated. We sit around, everybody sits around in isolation. Nobody goes out anymore, right? You don't need to go to the grocery store. You can have groceries delivered to you. You don't need to go out to eat. You got DoorDash, right? You don't need to go to a ball game. You can watch it on TV. And people are isolated. I mean, in a time like this, you need community. And that might be the biggest value of TFMR. The community aspect, everybody kind of helping each other along, finding bits of info, links, nuggets, prayers for each other if something goes wrong. I'm just really, I don't know. I don't mean to be boastful and prideful about the site, but I'm just really proud of the people that are there that have turned it into what it is. So I just encourage people to check us out. I mean, it's not free. It's $15 a month, but I think it's well worth it. Again, just right there, tfmetalsreport.com.
We'll put a link to that in the description of this video. Craig, once again, thank you so much for your time, and God bless.
Always fun, Elijah. Nice to see you, my friend.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.